Right now, 70% of Americans are either uninsured or dangerously underinsured. That's not a statistic from a decade ago. That is happening today. And the worst part, most of those people think they're covered. Welcome to Insure Smart. I'm going to spend the next few minutes showing you exactly how the insurance system works, why it keeps most people broke, and what the financially savvy actually do differently. Whether we're talking life, health, or auto, the fundamentals are the same, and once you understand them, everything changes. Let's start with the basics. Insurance is not a product, it is a contract. You agree to pay a small, predictable amount every month, called a premium, in exchange for protection against a large, unpredictable loss. That is the core transaction. In 2023, the life insurance coverage gap in America reached a staggering $12 trillion. That means the difference between what American families actually need and what they actually have is $12 trillion. And LIMRA, the insurance research organization, says that number is growing every single year. Why? Because most people either don't buy insurance at all, or they buy the wrong kind, for the wrong reasons. To understand insurance, you need to understand one concept: the risk pool. Here's how it works. Imagine 10,000 people who all face some small probability of experiencing a major financial loss. Maybe it's a car accident, maybe it's a health emergency, maybe it's dying too soon. Statistically, only a small percentage of those 10,000 people will actually suffer that loss in any given year. But nobody knows which individuals they'll be. So instead of gambling that you won't be one of the unlucky few, everyone chips in a small amount. That pool of money then pays out to whoever gets hit. This is the actuarial bargain. Insurance companies hire mathematicians called actuaries who calculate with remarkable precision exactly how much each person should chip in based on their individual risk profile. Your age, your health, your driving record, your job, your location, every variable gets factored in. Here's what most people miss. Insurance is not designed to make you rich. It's designed to protect you from catastrophe. When you file a claim for a minor fender bender, you're essentially pulling money out of a pool that is supposed to fund devastating losses, and the insurance company takes note. That's why your premiums go up after claims. You signal that you're a higher risk member of the pool. The financially intelligent approach: use insurance for what it's designed for, catastrophic risk, and self-insure the small stuff. Now let's talk about life insurance. This is the one type most people misunderstand completely, and that misunderstanding can destroy families. There are two fundamental categories: term life and permanent life. Term life is exactly what it sounds like. You buy coverage for a specific term, 10, 20, or 30 years. If you die during that term, your beneficiaries receive the death benefit. If you don't die, and statistically you probably won't, the policy simply expires. You get nothing back, and that's okay. That's the deal. Term life is brutally affordable. A healthy 30-year-old male can get $1 million 20-year term policy for around $30 to $40 a month. $40 a month. That is the price of a streaming subscription to ensure your family doesn't lose their home if something happens to you. Permanent life, and here's where it gets complicated, comes in several flavors: whole life, universal life, variable life. These policies don't expire. They build what's called cash value over time. The insurance component is combined with a savings or investment component. Here's the hard truth. Most financial advisors who are not paid by life insurance commissions will tell you the same thing. For most people, the right move is buy term and invest the difference. Why? Because the internal rate of return on whole life policies is typically terrible compared to what you'd get investing that same premium difference in a low-cost index fund over 20 years. Whole life has its place for high net worth estate planning, for certain business scenarios, for irrevocable life insurance trusts. But for the average working family trying to protect their income, term wins every time. One critical piece: the right amount of life insurance is generally 10 to 12 times your annual income. If you make $60,000 a year, you need at minimum $600,000 in coverage. Most people are wildly underinsured by this measure. Health insurance is the most complex and frankly the most contentious part of the American insurance landscape. Let me cut through the noise. Your health insurance policy has 4 numbers you must understand. Premium, deductible, copay, and out-of-pocket maximum. Premium is what you pay every month whether you use your insurance or not. Deductible is the amount you pay out of pocket before your insurance starts covering costs. Copay is the fixed amount you pay for specific services after meeting your deductible. And the out-of-pocket maximum, this is the most important number, is the absolute ceiling on what you'll pay in a calendar year. Here's a scenario that plays out thousands of times every year. Someone buys the cheapest plan they can find, a low premium plan. They're healthy, they feel fine, they never go to the doctor. Then one day they end up in the hospital for an emergency. Suddenly they're looking at a deductible of $5,000 or $6,000 before insurance kicks in, and their out-of-pocket maximum is $12,000. This is why you cannot choose health insurance based on premium alone. You need to understand your total potential exposure. That's your out-of-pocket maximum, and make sure it's a number you could actually survive. For prescription medications, always check the formulary before choosing a plan. That's the list of covered drugs. If you take maintenance medications, a plan that doesn't cover them could cost you thousands more than a plan with a slightly higher premium. And during open enrollment, which for most Americans runs November through December, do not miss it. Missing open enrollment can lock you out of coverage for an entire year unless you have a qualifying life event. Auto insurance feels like the most straightforward type, but it hides some real traps. Every state requires you to carry at least liability coverage. That's coverage that pays for damages you cause to other people and their property. But state minimums are dangerously low. In many states, the minimum liability limit is $25,000 per person. A single serious injury can cost 10 times that. If your liability limit is exhausted, your personal assets are on the hook for the rest. Liability protects others from you. Collision covers your car when you hit something. Comprehensive covers non-collision events, theft, weather, animals. Uninsured motorist coverage protects you when someone hits you and they have no insurance, which happens far more often than you'd think. In some states, over 20% of drivers are uninsured. Here is the single biggest mistake people make with auto insurance. They drop their uninsured motorist coverage to save $40 a year. This is financial insanity. That coverage is your last line of defense against someone else's irresponsibility. Also,